Cramer, welcome to a special West Coast edition of Bad Money. Welcome to Cramerica from One Market in San Francisco. Other people make friends, I'm just trying to make a little money. My job is not just to entertain, but put it all in context. So call me at 1-800-743-CBC. Tweet me at Jim Cramer. The market gets so angry over nothing. It's just plain irritable and very hard to please, like a 3-year-old child. But when you make it happy, the inner child giggles and your stocks will soar. Not that you can tell from the average today. I was hoping that things would be a little more, say, tame and, yes, even logical, so I could spend some time with you about what happens when artificial intelligence meets healthcare. Last night, we went to hear NVIDIA CEO Jensen Huang and Dave Ricks from Eli Lilly talk about AI and drug development. They've opened this facility out here that will apply accelerated computing and generative AI with the work of Lilly scientists to speed up the creation of critical new drugs. But somehow Wall Street treats that monumental effort like it's just a gigantic sideshow. Sell. Instead, we had a confluence of earnings news. The earnings season started today, along with softer inflation, courtesy of a decent consumer price index figure that came out this morning, and an insane new love for retail. Let's start with the market's temper tantrum, though. It's kind of cogent. JP Morgan is the world's biggest bank. We all know that. But CEO Jamie Dimon, cautious guy, and whenever the bank reports, he tends to say things that the market doesn't want to hear. And that's what happened 3 months ago when he talked about cockroaches in the credit market. He sent the stock into a one-day nosedive that crushed the bank's supporters. This time, JP Morgan actually reported a weaker than expected quarter. Not enough underwriting. And the stock eventually got hammered again. Worse, Jamie was back urging caution and getting tough about the right to charge high fees for credit cards to make up for losses. That combination created a tsunami of selling. We saw the same thing last time. I say wait a day or two, just like last time, so you can gradually buy this one weakness. Why? Because it will always bounce back. How do I know that? Because it always has. What else? The market's decided that if you make software, artificial intelligence will make your business obsolete. And that's why Salesforce, Adobe, and ServiceNow were all slammed again today. I mean, laid to waste. Meanwhile, the hardware that powers AI soared, led by once lowly worm Intel and AMD, although the market still won't show any love to NVIDIA. Most fascinating development today, the smothering affection for retail. I can't believe how quickly these stocks have become beloved after being hated for a year. Buyers can't seem to find a level to walk away from when it comes to the dollar stores and the discounters. Being a Dollar General, mine's a good one. I don't get it. Stocks aren't supposed to levitate like this. The wave of buying includes Walmart, of course, and holy cow, Target, with that 4% yield and a new CEO. Suddenly, Cramer fave Home Depot, the despot, has actual buyers, and Lowe's flirts with new highs. Wayfair won't quit. What's that? Neither will the flawless Ralph Lauren. What gives? I think the inevitable result of what happens when you have tame inflation, which is what we got from the CPI number this morning. The buyers cannot resist anything that benefits from lower interest rates that come from tame inflation. Even if oil's rallying off a geopolitical news flow, we're ignoring that one. Hey, you want hate? I'll give you hate. All you have to do is declare you're going for clean energy to power your data centers. If Microsoft and Meta platforms were to abandon their dislike of fossil fuels and go all in, say, on despise clean coal, or at least cleaner natural gas, they could actually lift their heads and not have them blown off. Without cheap energy, though, what really matters is that Alphabet increasingly looks like the only winner in AI for the moment, and it's partnered with Apple to power Siri and who knows what else. Winner! Of course, this is all day-to-day stuff that could be rolled back tomorrow. So why don't we just take one moment and talk about the big picture? We're still at the beginning of the year. We have these, what I call jailbreaks going on. Happens every year. There's a jailbreak in retail, jailbreak in oil, and a jailbreak in transports. Way too much love for those. But let me tell you where you're not getting the love. Out here in San Francisco. Man, open the Golden Gate already. What the heck? This JP Morgan healthcare conference that I spent the last 2 days, I've seen the guts of Pharma, the big healthcare companies, and I think they may all be undervalued here. Irony of ironies, by the way, Johnson & Johnson led the pack, and it was only one of a handful of drug companies that didn't present. I heard things from the likes of Cardinal Health, Amgen, Novartis, Bausch & Lomb, and Eli Lilly that were so perfect for this environment of lower interest rates that I cannot, or lower inflation and lower interest rates, that I can't believe their stocks didn't roar. They should be. More on that one later. As I said at the beginning of the year, though, the first 2 weeks are always a jumbled amalgam of love and hate, too much of both. But the bottom line, now that earnings season has started, the rehearsals are over. And we're going to begin to see the reaction to actual numbers. And if it's anything like J.P. Morgan, what can I say? It's showtime. Let's start with Bob in New Jersey. Bob!
Hey, Jim. Thank you for accepting my call, and thank you for a great show.
Oh, thank you, Bob. That's kind of you.
Well, I've been following you a long time. Now I got a question for you. Hopefully you can help me. I have Siri. I got about almost 400 shares of Siri, and I'm down 50% now. But I've had it a long time, and off and on I've made money with them. But right now I'm down 50%, and I'd like to know, should I keep
listen, we got that the wife, yeah. Hey, listen, we got a 5% yield, okay? And it can bounce back. Is it my favorite? No. Why? Because I like growth, and it doesn't have growth, and that's the real problem. All right, look, the first couple of weeks are very hard to decipher, but now that earnings season has arrived, it's showtime, and we'll get a better sense of where we're actually headed and all this curious amalgam that we put to bed. Oh, man, tonight, we have an action-packed lineup ahead for our second day at the J.P. Morgan Healthcare Conference. I sat down with some of the top leaders in the healthcare industry. Conversation with Novartis, Amgen, Regeneron, that too, and Cardinal Health. So don't go anywhere. And, of course, stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.